All right, Rick, let's just jump right into this. One day we're getting QE3, one day we're not. One day Spain's okay, one day it's Greece. What is the deal right now? Is there really a bullish or bearish case, or is everything just a wait and see at this point?
You know, I think it has to be a wait and see, because I think in the end that we use certain phrases and we confuse them. Stabilizing Europe after the second Greek bailout, or trying to stabilize Spain, those are all noble endeavors, but stabilizations aren't solutions.
Right.
And solutions require that the citizens of these countries get on the same page as their political leaders. So when you look at what's going on this weekend, Sunday, in France, Mr. Sarkozy probably isn't going to get 50% of the votes. Now, if he doesn't, of course, May 6th, the following Sunday, 2 Sundays after, they have another runoff election. Now, should he not win, what happens is that the gentleman that is the contender on the socialist left, who has a good chance to give him a fight, he wants to do things like lower the age of retirement. So see, the will of the people, they'll take the easiest route.
Of course.
Politicians haven't explained it well, and I think that this is the dynamic in our country that could or could not take away the punch bowl. I firmly believe QE is always going to be on the table whenever things look a little bleak, like right now with the 10-year back under 2%. The politics, our November election, I think, very similar to the elections in France, if incumbents have a problem, that's what's going to put Ben Bernanke and company in the box with further promises on more programs. But I think voluntarily, they're never going to put it far enough off the page for markets to believe it.
Now, speaking of politics, what about market speculation versus manipulation? That was a real hot topic, especially for us down on the floor this week.
You know, I never buy it, whether it was '08, whether it's now. First of all, speculation. Every market that's traded is traded by people that aren't necessarily in the business. So if the S&P goes up, there's a lot of people trading it that aren't necessarily in the business. But if the market goes up, everybody likes it in the government, Ben Bernanke, the administration, nobody says anything. When energy goes down like natural gas, you don't hear about this. So really, I think the beef isn't with how the markets work, and speculators or traders bring a lot of liquidity into the equation. It's really the direction that politicians have a problem with if it doesn't match their agendas. And I'll give you my analogy. One of the arguments against commodity trading and oil in particular is, oh, look at the explosion in volume, the explosion in players, the explosion of money under management in the commodity area. Well, I look at it this way. If I'm trying to sell a painting at an art auction, do you think I'm going to get a more fair price if there's 5 people in the audience or 5,000 people in the audience?
Right, I would go with 5,000.
Absolutely. You're going to get much more accurate price discovery. And for every buyer, there's a seller. So this notion gets lost in general when they talk about manipulation. When people trade energy, they're prone to be bidding it higher because the world's getting smaller. China has higher demands. The Middle East is getting more dangerous. So the direction is obvious. And when this market is bid up, I understand that the amplitude or the volume of the market might reverberate louder as you get more traders involved that aren't in the business. But to be off 10 or 15 or $20, as some say the market has been in energy, that sounds like, oh, it's a horrible spread. But offer me an alternative that's better. I contend if there was ever any other form that could do it better, we would have come to it by now.
Right.
So the fact is, if you take it out of the market's hands, which anonymously through aggregate trading try to allocate a scarce resource, but it's not perfect, what are we going to do? Turn it over to the government, the French government, or the German government, or the U.S. government to prick where oil prices go? My contention is any other process other than market, open, fair trading practices is going to give you a worse spread of $20. Maybe if the government had its way and they took it out of the hands of the free market, we might be off $60. You might see gas stations with signs that say no gas today. So before they start condemning the current structure, I defy them to come up with a more efficient structure.
And to set you off one more time, let's talk about housing speculation. What have we heard? 2 big things in the news this week. We're starting to lend again to subprime borrowers, and the other big thing is buying speculative foreclosures.
Listen, I will always be consistent. What private institutions do, how aggressive they are, how thinly they spread themselves as they try to go after housing again, and I hear it's multifamily homes are on fire as well, I have no problem with. What I have a problem with is that right now I hear from my friends there is a mini bubble forming in multifamily units. And many of the parties involved on the banking side could now actually get out of many of these positions they've been stuck on for years profitably, but they're not. Let's think about that. Why aren't they? Because they're now rolling the dice trying to make money on a trade that was a loser, because if it goes wrong again, what do you think they're thinking of?
Right.
That somebody's going to come again and bail them out with another program. So the moral hazard of bailouts just creates more and more problems. If private entities want to spread the mustard thin, as long as we allow them to fail, that's the way it's supposed to work. That
Right.
failure will be the best regulation for entities that follow them in this arena after they go belly up.
All right, let's kick it off with a positive note. Where do you see some positive signs in the market right now?
Well, I think one of the positive signs is going to be that next week we're going to have a lot of data points, okay? And one of the data points 1 week from today is going to be our first look at first quarter GDP. And even though very few are excited about 2.5%, and I think at this point in time beyond the recession, 2.5% historically is very weak, but I thought a couple of quarters ago it would be much less. So my half full is 2.5% isn't so bad. It's not nearly enough, but it isn't so bad.
It almost reminds me of the earnings theme this season, under disappointing. So, yeah, we'll have to see. We have to start deriving bottom line support, not just necessarily cutting costs or shifting the papers around, if you will. So
Exactly,
it's
and
gonna be
then the
something
government's balance sheet's exactly the same. If we're going to actually try to get the 5 million people, we have 5 million less workers today than we did before the crisis, okay, at the peak. Now, to get those 5 million people back to work, we need like 3.5 to 4% GDP. End of story.
All right, thank you, Rick.
Thank you.